Good evening, everyone. Live from Chicago, it's Thursday, October 12th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you're with us tonight. It's been just 3 weeks since our first fireside chat in 4 or 5 years, not sure which. Some time ago, yes, and we appreciate all of you coming out 3 weeks ago for that event. The next one of those simulcasts will be January 18th, and then that'll continue in May. So 3 times a year, we're going to do that simulcast in January, May, and September. And in the offsetting months like this one, we'll be on our YouTube show, CB3 Live. We're glad you are with us tonight. Rocktober is here. Oh boy. And the fourth quarter premiere, what could happen as we move forward here. For those of you that are new to the channel, please subscribe to us. Click the button, subscribe, and then hit the little bell so that you get notified whenever we go live. Sometimes I upload videos midweek just to show you something that's different than our show if something's happening in the news. And also follow me on X, which used to be Twitter, and Facebook and LinkedIn. I tweet every single day. I guess it's still called a tweet. You can't X something, but it's a pretty good idea to do that because I have tweets that come out pretty regularly and sometimes intraday when a lot's going on. These are the 12 segments that we cover. Only going to be 8 tonight because I really want to drill down into several of them because there's a lot going on. I understand that there's anxiety with what's going on in the Middle East, on top of Ukraine and Russia, and certainly what's happening in Washington. So I want to spend some time on that. The goal of this program, as it is every time, but especially tonight, is to give you some peace of mind an hour from now so that you realize that this is really just business as usual. I'm going to give you the data to support that. Hang with us, and here we go. So the monthly market review, October, not always a great month, and this single chart is going to tell you a whole lot about your accounts. Every once in a while, I'll have people call me and say, you know, how come we're not really doing much this last year or even this last 2 years? So look at the chart in front of you. There's 3 yellow circles. The first one at the top there is on July 6, 2021. Go down to the bottom yellow circle. Hope I didn't put too much luminance on that, but you should be able to read it. July 6, 2021. And then the other to the right of that is where we are today. See anything that looks kind of odd? That's right. The market is exactly where it was 27 months ago. So if your account has not moved in 27 months or moved very little, that's why. It's really hard to invest with a stock market. I mean, that's our medium of investment. It's sort of like having a sailboat and going out on the water and you need some wind. If the wind's only 3 miles an hour, you might be able to make a tiny bit of progress, but it's not at all the same as if it's 15 to 18 miles an hour, or they call it knots or whatever that measurement is. But the point is, it's a really difficult environment right now. And so we're just trying to hold our own with what we have. October is an extremely volatile month, arguably the most volatile. And I've broken this down in the first 6 days of the month, which if you annualize those are up 39, let's call it 40% almost. But then the 7th and the 9th down 33%, the 10th up 16, the 22nd through the 27th down 41%. All right. And then up 69% the last 3 days of October. Now, as I've explained to you before with this data, this is if you were to invest in just those days and not any other time during the year. But what that means is that amount of volatility puts October in the most stomach churning, hence the name Rocktober. All right. Don't know if it's going to play out this way this year, but it certainly has started that way. October has a bad rap because most of the market crashes, at least because of the market crashes in 1987 and 1929. None of us was really alive in the first one down, or the last one, I should say, 1929, but we all remember 1987. Definitely a difficult time. So it's actually been a pretty solid month for the last 20 years. So the way I can show you best on this chart is that look at July, August, and September. Now, I've gotten comments that I'm putting charts up here that are too difficult to read, so I'm trying to use these circle highlights. For those of you that were at the Fireside Chat last month, I have a brand new pointer that allows me to put these little circles on the screen and red dots and stuff. So come back in January and I hope it'll be more intelligible. So I'm trying to find the simplest charts that I can, but still give you poignant data. Clearly you can see July, August, September, those bars are going down. 2 of them are positive. September's negative. Remember, that's the only one that's seriously negative during the year. But the good news is October, November, December are each increasing in value. And then if you go back to January, 4 months together there are pretty strong. So this is historically the strongest time of the market once you get past the Rocktober days, which end on October 27th, at least historically. All right. So that explains some of why you're seeing the performance that you're seeing. Here's another reason. The 10-year government bond yield is at 20 plus year highs. Now, I'm only showing you back to 2021, but you got to trust me on this. we were seeing yields in the 1.5%, 1.25% range for years because the Fed funds rate was so low. But now with interest rates higher, when you can get 5% in a treasury bond, many people that are market participants will say, you know what, if I can get a guaranteed 5%, I'm going to take that rather than expose my capital to the market. Now with inflation at 4 something, your real return, real means after inflation, is 1 something percent. I mean, who wants that? There are some people that do. And the bond market is attracting some buyers because if they can get this kind of yield, they're going to take it. Still, you know, but this is how I end the first segment here. 85% of the stocks reporting, and only 20 stocks have reported. Okay, so that's a tiny amount. But we've got 100% of the industrials, 100% of technology that are beating their forecasted profits, all right, earnings reports, okay, which is top line and bottom line. Obviously, next month when I see you in November, this will be filled in a lot more, but that's a really good start for October, all right? The number one component of influencing market behavior is the employment report after interest rates, all right? And we cover both of these in this section. So first section talking about what has happened so far, and we're now looking forward to the rest of this month and November to see what could happen there based on this employment scenario. So 336,000 new jobs in September. The reason we do this on the second Thursday is because the jobs report is on the first Friday. And that gives me time to run through that data and see what I see and what I'm looking at. So September was a better month than everything in the last year. So this is looking back 1 year, except for January. All right, not bad. Let's look back 2 years. Now, it doesn't look nearly as impressive that January of 2022, February, was really, really awesome. All right, and many other awesome, but it's still positive. All right, still positive. And look at the line across the middle there. I hope I made that dark enough there. That's the 2017-2019 average. So there is plenty of room above that for this current report. Let's now go back 3 years. Okay, and you can see, yes, there are much stronger months, but we are still positive. Why is this so important? Because of what's coming up in the next segment with what's going on politically in the world. The market is holding its own. Yes, it's flat for 27 months, but it's not lower. That's important. And one of the reasons it's not is because employment remains strong. And that is why there is no recession segment tonight, because you cannot have a recession as long as we have these employment numbers this strong. Now, when we stop having these, or if we stop having these strong employment numbers, you can bet I will be following that and talking more about recession and what we're going to do to adjust your holdings to protect us from that. But right now, these employment numbers are good. Remember the V-shaped correction here in 2020? The trajectory of payrolls is now back on track, back to 2015. If you just, visually with your eye, take that out to the red dot, that's an impressive number. And in fact, I'm going to zoom in on that now so you can see this all the way back to 2018. So the pre-pandemic peak is that little dotted line, and it stops right there in February 2020, and then it keeps going. All right, we've exceeded that. We've exceeded that with the non-farm payroll. We've exceeded that with replacement labor force. Now, replacement means those are people that went back to work in the same jobs they had post-COVID, okay, as the workforce, came to rebuild there. The takeaway, and I really can't stress this strongly enough, other than interest rates, which are really important, we'll get to that in a second, non-farm payrolls and the employment story in America is the number one determining factor, because that drives employment. Employment drives the profit picture for corporations, and that's what makes stocks go up, and that's why we buy them. It is very, very difficult, as in never seen it in my lifetime, and even going back to the 1920s, when you can have a serious recession with employment, the unemployment rate at 3.8%. It's not going to happen. If that were to bump up to 4.5% or 5%, I assure you we'll be making adjustments in your portfolios, and I'll be reporting it right here. But right now, I'm looking at the data, and as scary as things are geopolitically, which we'll get to next, The market is still saying, stay invested, and thus we do. U.S. policy is important, and here's why. Politics, which I think we can pretty much safely say all of us hate. It is really an obnoxious political environment right now in America. But politics ultimately does lead to policy, okay? And policy has a personal impact. And it's a personal impact because it affects our portfolio. How about that for all those P's? Politics leads to policy, which affects our personal lives, which affects our portfolio. So I'll say hi to Keith, just out of surgery, folks. Keith is one of our faithful viewers, and he had surgery. Surgery came out great, and he's tuning in tonight. Thank you, sir. Julie, great to see you. Andre from New York, great to see you. So, long political section tonight because we all know what happened over the weekend. So the Israeli government, this is the worst attack on this country since the Holocaust. It's their 9/11 and could actually end up being far worse than 9/11. I mean, they're estimating now there could be 250,000 deaths before this is settled. So they have mobilized hundreds of thousands of people, reservists, men and women, and they are getting ready to do a large-scale ground attack. If I zoom in on this, you can see where Hamas came across the border, and of course, you don't need me to tell you what was done. It was horrific. Now, they're a long way from Jerusalem. They're a long way from Tel Aviv. I don't think that that's their intention. And if that were to be where they literally were trying to take over the city, the capital, I think you would see the fiercest fighting, since World War II, without a doubt. Right now, we're all in a wait-and-see pattern. And the reason that this matters is because it affects consumer sentiment. When people are anxious, I had one investor who's out west just said, you know what, I'm taking my money, I'm putting it in 5%. I have to wait till the markets calm down. And you can do that. The problem with that is if you'd done that during COVID, you wouldn't have had that 63% return we did because there was no calming down. There was chaos for 6 weeks in the market. If you remember that, we'll get to that farther on in the program. But these are the 7 reasons that I'm seeing of why this war was started. First of all, the appearance of Israeli weakness, and that's because I think they were prepared for the wrong war. I'll get to that in the next slide. I think Hamas wanted to trap Israel into overreacting and thus damaging its relationship with other Islamic nations, in particular Saudi Arabia, because Israel and Saudi Arabia, obviously Saudi Arabia is the powerhouse in the Middle East. Israel wants to be warm with them for several reasons. Number 4 would be the reason, because of their growing energy business, and Saudi Arabia is the number 1 producer. But they also want to disrupt the existing peace between Israel and the other Islamic nations. There's no problem with Israel and Jordan. Syria, not such a great relationship, and obviously Iran, a horrible relationship. And that's one of the reasons here. Number 5, Iran needs a war to keep the Islamists in power. It's sort of like the 9/11 excuse. Let's don't make any changes here because there's too much going on. And frankly, the weakness of America. Would this have happened if it happened during the Trump administration? I don't know. I don't think so. But I think the perception is that America is weak right now, and they took advantage of that. Frankly, I think that's what Putin did, and you guys have heard me say that previously on this program. And they also strive to harden and escalate the adversarial nature of East-West competition. The Middle East participants, for the most part, are not our friends. I think there's a massive amount of jealousy, and that is what is causing this lashing out at our political ally, which is Israel. This is a financial program. This is not a political program. But when world events happen that scare investors and therefore have them withdraw funds or put the brakes on investing, especially during a difficult time in the market for other reasons, like the political situation in America, which we're going to get to, then I have to pay attention to it, all right? And I make adjustments in your portfolio and then report them later. I don't discuss it on this show and then say, well, here's what we think we might do. I'm reacting on a sometimes daily basis to what's going on in the market, just so you know, all right? So Israel spent 3 years building this 40-mile long state-of-the-art high-tech security barrier, with radar sensors and everything. I mean, it was said that they could, if a dove landed on the fence, they could tell you how many pounds it weighed. But the problem was that they were preparing for the wrong war, because Hamas attacked them with, I want to say, crowbars and, caterpillars that just tore down the fence. Of course, it wasn't exactly a huge fence like what we have on our southern border, or like what we've started on our southern border. But Israel was simply caught flat-footed and unprepared. So obviously now the financial markets have to price in this new violence and adjust trading strategies. The way we've done that is on our GI program. Many of you have both of our programs, or some of you have all three. But CG is the growth program. We're still 100% invested, technically 99%, but fully invested in CG. We have gone to a little bit more fixed income in GI just because of the volatility, and there was just nothing that I saw that was attractive to buy for a conservative-minded program. And it's holding its own. We're happy with where that is. But tragic as this is, guys, I said this earlier, markets don't really care that much about the economic demand in Israel. It's the 28th ranked GDP in the world. We're first, China's second, Japan's third. And much less the West Bank and Gaza, obviously coming in at 120th, but rather what it means for an OPEC member nation like Iran. Third time I have to say this tonight. I am not in any way minimizing the enormous human cost and tragedy, just horrible, horrible treatment. They can't even show the pictures on TV. It's so bad. But my job on this program is to let you know how I'm protecting you and your money, and that's what I'm doing, okay? So there's really no denying that war has a negative immediate impact. So underline that word like I did in your mind. It's an immediate impact on the financial markets, particularly when one of the world's major markets is affected. That would be us, or China, or Germany, or Japan. Some other areas of the Eurozone, but those are the big ones. However, after an initial sell-off and a period where investors cringe, markets recover relatively weakly. You can see what happened here in a several-week period when Russia invaded Ukraine. A month later, things were pretty much okay. Let's look at a much larger time frame here, 120 years. So we're going back to World War I. I highlighted that in yellow. And yes, there was a lot of volatility, more than there was, say, in the 1900 or 1905, 1910 range. And then obviously the Roaring Twenties, the Great Depression. And in World War II, things went down, but then when the war was over, look at the market recover from there. I didn't highlight, I forgot this, in yellow, the Vietnam War. You can see the shock there, but then it's off to the races again. Fourth time. I am not minimizing the human cost. I mean, we lost hundreds of thousands of Americans during these wars, as well as other citizens around the world. But for whatever reason, the markets want to take the pulse on what's happening. Historically, you can see that for 100 years. Once they get an assessment, okay, it's not the end of the world, we're going to go back to business as usual, which means where are the earnings, what are the interest rates, and how are the corporate earnings? All right, that's the way it works. So one of the barometers of how we know whether a situation is going to metastasize into something worse is the price of oil, because everybody needs oil. Even Tesla, because their charging stations are powered by carbon fuel, okay? So you can see the spike here that happened on October 7th. So this is just the month of October. This is just 12 days. And then it stayed about that same $86 a barrel, and then it's just drifted down to $82.50 now. And in fact, in Spec Op, we are short crude oil again. We went long and then got stopped out of that trade, and we're now short crude oil. And again, I can make all the assessment that I want that says, but this doesn't make sense. I don't want to be long crude oil. We're going to have danger. Saudi Arabia is going to jump in and withdraw all their, supplies to us. Well, obviously, if we were completely energy independent like we once were, we wouldn't have an issue there. But all of this matters because this is the sentiment that affects how people feel during a war. And I'm showing you this to say the traders that trade crude oil are not pricing in a long-term conflict or one that's going to have an adversarial relationship with their money. Just the way it is, guys. So the Israelis and Palestinians have had these wars for decades. I want to be clear, in my humble opinion, this attack marks the end of this decade-old belief in Israel that Palestinian aspirations for sovereignty could be indefinitely put aside while the rest of the Middle East forged ahead. No, that is over. In other words, the status quo is done, and it is done forever. All right. There's more going on than just the Israeli-Hamas war. The House fired its speaker since I saw you at the fireside chat. This has happened 0 times in American history. Who actually voted them out? The Republicans teaming up with the Democrats. How crazy is that? Only in America. And our adversaries and allies are just going, sheesh. All right. But Steve Scalise now has won the nomination. He hasn't won the vote in the full House, but he beat out Jim Jordan of Ohio and looks like he will be the next speaker. But again, uncertainty until that's in place because, as you probably remember, they kicked the can down the road, and now in mid-November, the government's going to run out of money again. We really need a speaker to get this fixed, okay? Hope the Republicans can get that straight. On top of this, Robert F. Kennedy, this is the son, his father's name, of course, is going to run independently. And what does this mean? Is he going to draw votes from Biden or whoever the Democrat nominee is, or is he going to draw votes from Trump? And Trump will be the nominee. There's no question about that. Nobody knows. Now, the last independent was Ross Perot. You guys remember that? And his famous line, I'm going to try the accent. Y'all got to hear that famous sucking sound down there when all these jobs are going to Mexico. It's not very good, but you get the point, okay? He was kind of a cracker, but really, really smart guy. And he took votes from George H.W. Bush, and that's why Bill Clinton was elected, okay? So Robert Kennedy's not going to take enough votes, but it could create some uncertainty in this upcoming election. And that's why I have this section, because uncertainty creates angst with consumers. 3/4, 2/3 really, of the economy is consumer spending driven. I have to pay attention to what the emotional temperature is of the American consumer. Because when they're consuming, they're buying. When they're buying, companies need to make more widgets and produce more services. When that happens, their stock goes higher, and I need to be in those stocks. It's that simple. It's a chain reaction. That's why we talk about these things. All right? Makes sense. The Fed. Got a question here? Anything? Scalise just dropped out of the speaker race. How did I miss that? Wow. Keith, type in the box here. When did that happen? Steve Scalise is withdrawn from the... Okay, you both said it. I'm sorry. I'm trying to watch my questions and do my show too. Thank you. Somebody look up why. Does that mean Jordan's going to get it? I mean, okay, I got to go back on camera. This is what I mean about breaking news. I was watching the news until 6:45 tonight, while the pre-roll was running, and I still missed this. So thank you, my valiant audience. Somebody figure out is this because they did a straw test, a straw poll as they call it, and Steve Scalise can't win enough votes? Is Jim Jordan now from Ohio, the senator, going to get the nomination, and they're going to go to the floor with him? Anything you guys know, feel free to type it in the chat box. I want to keep going with the Fed, but just happened. Okay, so I'm feeling a little bit better, but I didn't let you guys down here. So this is the minutes from the latest Fed meeting. So the Fed meets 8 times a year. It's a goofy schedule. And then they announce interest rates, and then they release the minutes of the meeting, which is another market event. So here's what they just released. Well, not just released, but 2 weeks ago after the previous show. All right. Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have slowed in recent months, but remain strong, and the unemployment rate has remained low. Inflation remains elevated. I'm sorry for the little tinge of sarcasm there, but it's like, okay, tell us something we don't know, Jay Powell, please. The U.S. banking system is sound and resilient, unless you're a California bank that got towed under, but I digress. All right, tighter credit conditions for households and businesses are likely to weigh on economic hiring, activity, and inflation. The extent of these effects remains uncertain. Jay, everything remains uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and an inflation rate of 2% over the long run. In support of these goals, the committee decided to maintain 5.25%, 5.5%. Here's what some of us in the industry thought, that maybe just once, that the Fed would, grade on a curve. Let me just make this up, grade on a curve. So in other words, it doesn't get to 2. How about 2.5, 2 5/8, 2 3/4, even 2 7/8 inflation? Is that going to be okay? It's a 2 handle? No, they're not going to do that. So the last mile, if you're in logistics, to get that from your local warehouse to the recipient's home address, that's the most expensive mile. The most expensive to the economy, meaning keeping rates higher, is when the Fed doesn't want to budge because they are so hell-bent on getting that inflation rate down to 2.0 rather than a 2.5, 2 5/8, something like that, which would really be better for the economy, in my opinion. So the probability of a Fed rate hike in November has plummeted since August. Look at that, 70% chance down to 7%. So the market is telling the Fed, look, we can see the conditions here, don't be boneheads. That's exactly what the market players are telling them, all right? So you can look at this curve just going forward in October, all right? And it goes all the way out to August 2025. So now is the red line. 1 week ago is the blue line. So things have really dropped based on the war. So this is terrible to say, but the benefit of the war, the participants are going, there's no way the Fed is going to raise when there's all this geopolitical angst. They're not. They're going to coast at the current rate. Why is this so important? Because consumers watch that rate. If you're going to buy a new car and you're debating whether you can afford a 7.5% interest rate or 8%, you're just going to stand aside for a while. The Fed doesn't want that. They want you to continue to buy, but just not buy crazy. I don't know how you decide what buying crazy is, but that's pretty much the inferred remark from the Fed. So here's another example here. This is from Oxford. So they have a good survey here at Oxford. This is showing the forecast dropping all the way out to 2028. All right, the forecast for the interest rates. So they're back to a 2% target by 2026. And yes, that's 2.5 years from now. I get that. But it still gets us there. And it gets us there in pretty decent fashion. So the Fed officials are doubling down. This is what I just said on this 2% inflation target. They're not going to budge. They're not going to settle for 2.5, 2 5/8, 2 7/8, 2 3/8, 2%. All right. With inflation down significantly since last year, some have wondered whether the Fed would budge. I don't think so. And that's because Jay Powell does not want to go down in history. It's all about the governors, the 12 of them. They don't want to be the Fed that could not harness inflation in America. They Zimbabweized America. They don't want that, all right? It should be about you. You're the American citizen. It's all about them. Inflation. Have to address this, but it's pretty simple. Pretty simple and straightforward. Wholesale inflation rose 0.5% in September. A little bit more than expected. Expecting 0.3, came in at 0.5. All right. Excluding food and energy. Now, why do they do that? There's 2 ways to measure it. Okay, X core, and then including food and energy. But food and energy are the problem. Okay, the Fed likes the lower number. It's a higher number when you include energy and food. All right, still a little bit higher than they wanted. And just today, literally about 10 hours ago, the U.S. consumer price inflation rose more than expected in September. So again, Fed doesn't like that number. If the Fed doesn't like it, that means that market participants don't like it, because when Fed officials don't like something, they might increase, but they're at least going to leave things where they are. The market wants to start seeing the drops. I mean, the day that the Fed funds rate drops to a 4 handle, which is probably going to happen in 3 steps, because I don't think they're going to drop 75 basis points like they increased 4 or 5 75 basis point increases in a row. Crazy. They'll start dropping in quarter points like Greenspan did 30 years ago. All right. But we're not there. We're just not there yet. So in September, the consumer price index increased 3.7 from 12 months earlier. It was the same rate as August. So what I'm saying by this is in IMHO, and you guys know that acronym by now, it's a good sign because inflation, if not fully ebbing, is at least stabilizing. All right, that's a good thing. So, hey Deb, how are you? Good to see you. All right, economic indicators. So guys, when I'm talking about these are what I'm looking at going forward. Now, this is part of my 4th quarter preview that I talk about in the thumbnail, which you guys see. So in addition to being Rocktober, what are we seeing looking out through Christmas and into the year? So what could influence the markets? Number one, U.S. factory orders finally beat expectations. You can see crazy low in 2020, crazy nice response, dwindling down from there, went negative in 2022, several months, but now the strongest month since the beginning of 2022. Good to see that. Note that it's ex-transportation. Why would that be? Maybe because there's a strike going on. Yeah, could be. All right. The federal deficit. This is a concerning factor. The one that's published is without student debt cancellation. The red line is with student debt cancellation. Why does this matter? Because the Supreme Court voted that you cannot forgive student debt. Did the Biden administration listen to that? They did not. They found a way around it, and they're still forgiving hundreds of millions of dollars of student debt. Whether you believe this is right or not really my place, but I have to tell you that this does not help fiscal responsibility for this country, which means it creates an instability, which does not help market participants. Now, here's something else that concerns me. ACT scores for the class of 2023, 6 consecutive declines. Look at these plummets: reading, science, overall, math, English. And this is here in America. Do you think that these scores would be similar in Bombay or New Delhi or Manila or Tokyo? They would not. Wake up, young Americans, if you want to be able to compete in a world economy. So, small business optimism. This is important because mostly Americans, even though we have the Magnificent Seven, huge trillion-dollar companies, small businesses are still the pulse of America. And confidence has been under 100 since 2021. 100 is kind of the middle point. See how it was positive in 2017, 2018, nice and strong, plummeted 2020, and it's just been on a downward move since that point. So this is a really important gauge for me because small businesses hire, small businesses make widgets, small businesses grow larger and get sold to big companies, and then entrepreneurs often start something again. But this is an engine that keeps widgets being made, keeps the consumer spending, and therefore makes companies attractive because they're selling more and their stock prices are rising. And we're always trying to find those. So one reason consumer spending is proving so resilient, even as the Fed's raising interest rates, is that seniors, many of us on this call, not all of us, I get it, but many of us on this call are living longer and spending a lot. So Americans age 65 plus accounted for 22% of spending last year, the highest share since records began. Look at the red line. That's the 65-year-olds. Now, interesting, what was the biggest spending demographic? It's hard to see the little gold line there, but look carefully. Back in 2005, that was the biggest category, 45 to 54. So go forward 20 years, and now those boomers are 65 plus. So it's still us spending a lot. We are our parents, the greatest generation, were not spenders because they or their parents, our grandparents, had lived through the Great Recession, the Great Depression. All right. So anyway, I think this is a positive. I'm glad to see that the seniors are spending. I like it when any demographic in America is spending. AI, the formidable future. All right. Why you won't be able to avoid AI at work or at home. I read this story this week. So Sally, planning a vacation, she uses OpenAI's ChatGPT and Google's Bard, two huge popular AI engines. So she said she used the two engines to plan an 8-day Hawaiian vacation, helping her pick a hotel, designing itineraries for every day of the trip. So that means all the excavations they went to or excursions they went to, sorry, let's get the words right. And who knows if they went to Maui, but wherever they went, she got it done in 2 days. No paying a travel agent, got the best prices, and the dialogue between her and the chatbots was really helpful. Gave the chatbots many parameters, how many people are attending, dietary restrictions, which help the bots choose the proper restaurant. I mean, I'm blown away by this, guys. It's really pretty amazing, don't you think? So let me finish the story. But, they're going to need to rent a car, ask if you want to refine the suggestions, and then prints it out and ranks the hotel by price and stars. And, all this legwork that we would normally need to do sitting there on Priceline or whichever one you use, or if you're using, a regular booking agent. So there's no way to get away from this, folks. It's going to be here. And in fact, this little survey here interested me from Massachusetts Institute of Technology. I could have just said MIT, much easier. So we're looking at, prior to starting a task, how many minutes it took to do something, and then infused into the process was a group of the test people here that had access to ChatGPT. And look at the amount of time that it dropped. So a similar task, the second time, you can see the black line indicates that people without ChatGPT still did better because they'd already done it once. But look at the huge increase in efficiency for the people that had ChatGPT. And the grade, this is, actually scoring on how your grades are doing. So grades increasing significantly for those that have access to this ChatGPT. Now, I don't know when you're going to see this in school, or obviously people have to surrender their phones or something, but I have to believe that eventually AI is going to be as integral as having a calculator on your desk. It'll be interesting to watch this. And of course, we are watching as your portfolio manager because we want to see how that affects the companies that are making these services and how we can invest in them and make money for you. So what a large language model's trying to do, this is according to Jim Mazza here, who's Foundry AI, which is a pretty big company. They're not trying to provide correct answers, but pleasing answers. I found that alarming, but I think it's accurate. In the beginning, they want to be liked. It's like a restaurant, not necessarily healthy food. In fact, 100% not healthy food. It needs to be enjoyable food because that's what we're in the business to do. Well, you're not going to use these AI tools if you're not getting pleasing answers. So here it is, word of the day. Its job, meaning AI's job, is anthropomorphize. I know I couldn't get it the first time. All right, we're going to try one more time. Anthropomorphize, which means to give answers that people like, to attribute human characteristics to an animal or object. I really worked on that, guys. But anyway, there's your word of the day. You're going to see that a lot because humanizing these bots so that they will be able to push back and say, I know this is probably what you want to hear, but this is really what's in your best interest. We're not there yet, but it will get there, in my opinion. So, simple update here. I just gave you the performance. If you guys are, some of you guys will ask me from time to time, you want to see extensive performance. I did that last month, okay? And I'm going to break out that module probably in January so you can see the whole CB3 methodology from start to finish. Go back to the show 3 weeks ago and you can walk through that. I know that the visuals were not exactly the way we wanted them because I wasn't in the studio like I am now. I'm out live, but we're going to do a studio recording where you can see all that. But I will give you this update. So this year, we were underperforming the S&P. We're the blue line. This is CG. And the S&P, and so, the market had a pretty bad downturn in, not really, 5% in March of 2023, and we caught up and exceeded it. We had two bad earnings reports in a couple of our stocks, and then we're stopped out of them. And so we're lagging here in the last couple of weeks, but we're tracking pretty well. We're happy with where the new risk management strategies are. Again, if you want to see how this plays out, watch last month's show. And there's about a 15-minute segment on the CB3 methodology. Okay, guys, that is where we are tonight. Still a quick review. So the monthly market review, Rocktober is the most volatile month of the year, attributing back to 1929, 1987. But for the last 20 years, it's actually been a decent performer. It sets the course for how the rest of this quarter is going to go. And as you saw in the charts in the monthly review, November and December and then January of the following year are three of the strongest months of the year. The employment scenario, we can't have a recession as long as the unemployment rate is around 3.7, 3.8. It's just not going to happen. Still strong there. U.S. policy, so much going on, obviously, with the Hamas-Israeli war. That's going to be changing on a day-to-day basis. When something happens, I did tweet intraday when that happened, and I will probably be doing more of that as this develops. But I'm just going to break off camera again here, or break on camera and say, the market is going to assess where this is and that it's holding its own right now. It kind of fell apart here at the end of the day today. The first part of this week was strong, and this invasion happened Saturday. So I'm seeing the market stabilize. I'm encouraged by that. All right. The Fed, just in a tough place. You know, they really want to get inflation down to 2%. I don't think they're going to grade on a curve. I think they're going to just keep pushing until they get near that 2. I could be wrong. I hope if they stop at 2.5, I'd be fine with that. Inflation still strong at the PPI level, which is the producer price index, and CPI, consumer price index, still strong, too strong, but stabilizing. Okay. No recession module tonight, because I said no reason to cover that. Housing, nothing really there to speak of. Economic indicators, a variety of things from industrial production being good to our SAT scores being not so good. All right. AI, I'm just going to keep giving you examples from that so that you know where things are. This is a fascinating development. This is essentially as big as when the internet came out in 1993. I was not doing this program in 1993. There was no YouTube in 1993. Okay, so, and then of course I showed you performance. So I'm going to just put these last two on the screen. Guys, send me your questions. I'm going to get a sip of water and we'll wrap up. Put it on your calendar. Thursday, November 9th is the next CB3 Live. I like this quote, because it's a situation that's in this country right now, which I find very sad. One of the sad signs of our times is that we have demonized those who produce, we have subsidized those who refuse to produce, and canonized those who complain. Thomas Sowell, he said that 45 years ago. 45 years ago. And in summary, I always finish with this: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Got any questions here? Andre, one of my big employees, is using ChatGPT in his schoolwork. Yeah, I think it's going to be real interesting how the school districts, the superintendents, the teachers, you can bet they're having, my daughter's a teacher in Baltimore. And I've sent her several articles. She went, wow, I just, didn't realize that. Obviously, you've got a ton of students. You've got to be there for them and paying attention to what they're doing. So interesting times. I hope that my goal when we started this program was to bring some peace to you. We're going to be fine. Does not take or minimize anything away from what's happening in the Middle East with people just suffering horribly. Pray for them. If you're a praying person, give thoughts that way. If you're not a person of faith, we're very blessed here in America. And in these very difficult times, even though from our very first chart, we've moved nowhere in the markets for 21 months, you could say, well, I just should have pulled my money out and then put it in today. Well, had we known, you could have done that. If you knew that and you could have convinced me, I would have done that. But I know better. 32 plus years doing this tells me that. So I think I've gotten all the questions answered. CB3@cb3.com. If there's anything you want to know more, at CB3 Financial, we don't just manage your assets, we become one of them. We are here for you. We really appreciate you guys. Thanks for watching. Tell your friends, and we will see you in November.